Let's now focus on TCRS. TCRS delivers an expanded suite of digital customer services as a trusted partner to a global client base, driving local and international growth, leveraging its low-cost South African rand-denominated resources, analytics capabilities and tech stack developed over 2 decades. 3 structural shifts support South Africa's and TCRS's growth and relevance within the sector. Firstly, consumers are shifting towards omni-channel experiences. Next, there is a labour shortage in the developed economies due to the phenomena widely termed the Great Resignation. And finally, the operating models of consumer-facing businesses are under strain and are trying to shift from fixed to variable cost structures through outsourcing. South Africa has recently been ranked as the top destination to provide outsourced services due to its robust but low-cost rand-based infrastructure, the excess supply of skilled labour, our neutral English-based communication style, and the significant investment in technology, including well-functioning work-from-home capabilities. TCRS's business model is highly relevant and is strongly positioned when considering all of these factors. From a consumer credit perspective, the SA macro and socioeconomic environment is placing pressure on consumers who continue to be adversely impacted. In South Africa, there are 40 million adults, 26 million of which are credit active, and 1 in 3 of these are considered non-performing or in arrears. Our own index, the Transaction Capital Consumer Credit Rehabilitation Index, shows that the distressed consumer's propensity to repay debt is deteriorating. Resulting from this adverse consumer credit environment, overdue balances continue to increase, with 63% of the low-income segment in default. Although the consumer credit sector remains under strain, credit extension has increased, with consumers benefiting from lower interest rates and the cost of servicing debt reducing to 7.5%, down from 8.5% in December 2020. TCRS's clients thus have larger NPL portfolios than ever before. Their balance sheets and operations are under pressure, and they are all trying to shift from fixed to variable cost structures. This, together with the consumer's impaired ability to service their debts, increases our clients' appetite to sell NPL portfolios or enter into outsourced collection arrangements. In South Africa, TCRS is strongly positioned to accelerate the acquisition of NPL portfolios and win agency collection mandates. TCRS's evolution over the past few years has enabled it to expand its total addressable market, diversified by service, sector, geography, client, and mandate. From this slide, you can see that current services have been expanded outside of our core collection services to offer an augmented suite of customer engagement services. Revenues are being generated from clients in the UK, in addition to South Africa and Australia, but are fulfilled through our low-cost but efficient South African infrastructure. The growth potential is massive when considering TCRS's ability to enter new geographies and develop new services. Growth potential is also available from new sectors, clients, and mandates. This all positions TCRS for accelerated growth, and in a very difficult year, TCRS was able to grow earnings by a staggering 25%. This slide shows that investment activity and collection performance have both been excellent. Our 745 million rand investment into non-performing loan portfolios is 94% higher than the prior year. We expect growth in the market for NPL portfolios in South Africa to continue accelerating as the impact of COVID plays out over the medium term. Our asset base, or carrying value of acquired NPL portfolios, at 4 billion is 46% above 2021 levels. This has driven principal collection revenue up by 39% in total. Looking forward, expected remaining cash flows has grown by 17% to 6.9 billion, supporting strong annuity cash flows and predictable growth in the future. It's important to understand that TCRS has the ability to adjust its pricing methodology to the prevailing environment. This ensures that future NPL portfolios are priced with the environment in mind to achieve targeted returns and collection multiples. TCRS's operational and financial performance has been excellent. Headline earnings increased by 25% to R164 million, driven by significant operational leverage as non-interest revenue increased by 14% and operating costs increased by only 9%. The cost-to-income ratio improved to 81.8%, driven by the proactive restructuring of TCRS's staff complement and infrastructure during 2020. This included the implementation of highly effective work-from-home capabilities, with our call centre staff working on a rotation basis, but most of the month at home, at increased efficiency and productivity. Over the medium term, we anticipate that TCRS's earnings growth rate will remain at these accelerated levels. Looking forward, TCRS is well positioned to capture emerging opportunities. Within the collection services sector, we expect accelerated acquisitions of NPL portfolios in South Africa as sector dynamics become clearer. Within digital customer services, we are growing new revenues and profits from an expanded suite of services, delivered to international clients but fulfilled through our South African infrastructure, creating jobs locally. The opportunity to expand our services, clients, sectors and geographies is enormous.